Environmental. This has come up newly now. Environment. And last one is legal. Legal. So these are all the fundamental things about the economy. Okay. These are the fundamental points of any economy. Political, economic, social, technology. If any country is growing in all these 6 areas, then it is said that the country is growing. Legal means what? Legal is also an important point over here. Why legal is important? Because I'll tell you, simple example I'll give you. In our country, in India, the check is valid for how many, what is the period of validity of any check? In our country, the check is valid for how many days, months, years? Yeah, 3 months, correct? 3 months. Okay. Now, why legal is important? Look at this, 90 days, 3 months, correct? Why legal is important? In Dubai, UAE, Dubai, the checks are valid for, do you know how many, what is the period for validity of the checks in Dubai? In Dubai, the checks are valid for 2 years. 2 years. Means one check if I give you, that will be valid for 2 years. So that's why legal system is very important in the country. Whenever you enter any country or whenever you want to check any country, so legal systems have to be checked. Okay. Next one, technical reasons. Now technical reasons are short-term reasons. These earlier ones were all long-term. Now these are short-term. Short-term means what? Government controls. Like in China. What happens in China? Look at China. China government controls everything over there. Their rates, everything. So this is known as direct interference. In China, government directly interferes with the exchange rates. So can lead to unrealistic value of the currency, resulting in violent exchange rates. In India, do we have the government control? No. Government doesn't directly interfere in the exchange rates. In India, we have we call it a open market system. Open market means it is decided by the demand and supply. But in China, it's not so. Capital tends to move from lower yielding to higher yielding currencies and results in movement of the exchange rates. Always remember, suppose if you think of yourself only, if you are having any FD in one bank which is giving you around 4-5% rate of interest. Now, if there is a bank, other bank which is giving you 7%, you'll always think of investing in that bank. Why? Because you are getting higher yield. So any bank, any institution which is giving higher yield will always tend to attract the capital. Second is speculative forces. Now, what is speculative forces? Middlemen. What are middlemen? Like the brokers. Suppose if you go to buy a plot or flat in any of your city, wherever you are staying. Suppose if you go to buy a plot or flat, what happens generally we face with those brokers, right? Middlemen. So these brokers will tell you, sir, madam, buy this flat today, buy this property today. Within 2 years, the rate will go up because there is a highway passing near this flat. So the rate will go up. What is this? This is known as a speculative force. The middlemen are known as the speculative forces. These speculative forces or these middlemen tend to control the market. Okay? So they can have a major effect on the exchange rates, that the currency will be devalued and the speculator will short sell. Now what is short selling? I'll show you that also. See here, the speculator will short sell the currency for buying it back at the later date. So that is known as short selling. So what is short selling? Short selling means whenever I sell anything which I am not having and then buy it at a lower price. Let's say I'll give you a simple example. Suppose if I am seeing right now the share of Reliance. Okay, let's say Reliance is at right now, example I am giving. It's let's say at 2600. Okay, and I feel that the Reliance share will go down to, let's say, 2400, will go down in next 1 week. So what will I do? I don't have a Reliance share, but I'll sell it right now. Sell without having it. Sell it now. So step number 1 is sell. And when it goes to 2400, then I'll buy. Okay, I have sold something which I was not having it. So this is known as short selling. Short selling means selling something which I am not having and buying it later when the rate goes down. Now give me the answers. The term foreign exchange is used to denote dash as well as a dash of one currency into another. Oh, this is a bit difficult one. First one I'll answer. Okay, first one is because this is directly from your book. Okay, so I'll answer this. So first one is, you might not be knowing it. So it is known as foreign currency. Foreign currency. Okay, is used to denote the foreign currency as well as dash of one currency into another. Now this you should answer. What is the second answer? As well as dash of one currency into another. Two currencies. Yes, very good. Exchange. Exchange of one currency into another. Exchange. So Forex involves both the things. The currency also and the exchange also. Okay. The exchange rates of major currencies fluctuate every dash seconds. This dash seconds. How many seconds does it fluctuate? Correct. It is 4 seconds. 4. The Forex markets are dynamic and round-the-clock markets. Obviously true, isn't it? Whenever you sleep, market doesn't sleep. Okay? Market goes on and on. So these are dynamic markets. True. Correct? This is true. Forex markets are not affected by government policies. Not. This is what, true or false? Second one is false. A large part of the total Forex, global Forex market, results from global commodities trade. True or false? A large part of the Forex market results from the global commodities trade. Is it true or false? Correct. This is we all feel it is true, but the answer is false. Okay, the answer is false. A large part of the global Forex turnover does not result from the commodities market. It does not. Remember, it results from the investment market. Investment. Always remember. The major part in the world of the Forex currency is investment. Yeah, it's investment. Okay. So these are the answers. Look at this. These are the answers I've clicked in. Okay, that's okay. Now next. Most of the Forex deals are done on spot basis. Now, what is spot? This you have studied in your CAIIB, right? Spot means what? Okay. Before spot, let's come to this other terms. Cash, term, spot and forward. You have read this cash ready? Cash ready means what? Remember, you have read this word as a common word in your CAIIB. Cash ready, right? But it's not a one word. These are two words. Cash is separate and ready is separate. Both are the same names. Means either I can call it cash or I can call it ready. Okay? Anything I can call it. So it is same day. Same day means what? Suppose if I give you the money now, you should give me the goods right now. Like you purchase anything, you go to the vegetable market. Okay? Whenever you go to the vegetable market, in that market you purchase it immediately, right? You give the money then, now only. And then the money is, the goods are received now only. So that is cash ready. Tom means next day. You give the money right now. Tomorrow you will get the delivery. So this all relates to settlement. Everything over here relates to settlement. Settlement date. This is called a settlement. Means if I give you the money now, when will I receive the goods? Okay, this is known as settlement. Or reverse case also. If I give you the goods now, when will I receive the money? So Tom is next working day. Remember, working day. Working means not the calendar day. If today it is Friday, then the next working day for this is Monday. Remember, in Forex market, Friday, after Friday, directly comes Monday. There is no Saturday working in Forex market. Okay? After Friday, directly you come to Monday. So suppose if I tell you Tom of Friday is Monday. Spot, next to next working day. This is also called as second working day. Second working day. Okay? Second working. Next to next is also called as second working day. So suppose if I tell you today is Thursday. Thursday. What is the spot? Spot of Thursday. So spot will be when of Thursday? Spot of Thursday will be when? Friday and then Monday. Remember. Okay? If Monday is a holiday, then it will be Tuesday. Got it? Yeah. What is forward then? Forward is any day after spot. Any day. Any day after spot. That is forward. Means what? Suppose if today is Thursday and I deal with you saying that forward. We'll deal in forward. So it means that we will have the settlement after Monday. It can be on Tuesday. It can be a Wednesday. It can be after 10 years. It can be after 10 years, 100 years. I don't know. It can be 100 years also. So after spot, any day. Any day. That is called as forward. Generally in India, we trade the forwards up to 3 months. Generally in India, we trade the forwards up to 3 months. But remember, there is no compulsion for anyone. Because forward market is a OTC market. What is OTC? OTC means over the counter. Means what? What is over the counter? Over the counter means suppose you and me come together and decide on doing the business. I'll sell you something, you will pay me something. So it's up to you and me to decide. Suppose we decide that you will be paying me after 10 years. So it's okay. We have decided, we both have agreed to it. So this is called as OTC market, where there are only two parties. Now comes an important word over here. Okay, there are two parties over here. So OTC forward market, forward equals to OTC, over the counter, equal to two parties. Okay, buyer and seller. Now next comes the future market. What is future? Future is known as an organized forward. Means what? Now future is not OTC. Future is a brother of forward. Future equals to forward only. But there are three parties over here. Three parties. Which are the three parties? Buyer, seller, and third one is exchange. Exchange. Okay? Exchange. Buyer, seller, and exchange. So here what happens? In future, the exchange decides the rules. Exchange will decide the rule. Okay? So that is known as future. So that's why it is a third party, three-party system. Like we have right now also, everyone amongst you buys the shares. Do you buy the shares? How many of you have brought the shares, Demat account? Okay? Many of you might have brought the shares, right? Yeah? So in that case, tell me, when you buy the shares, do you know who's the seller? Do you know who's the seller? Suppose if you tomorrow buy Reliance shares, 10 shares of Reliance. Do you know who has sold those 10 shares? No. Why? Why don't you know? Because there is an exchange in between. Exchange doesn't let you know the buyer and the seller. NSE and BSE both. So exchange doesn't let you know the buyer and the seller. Okay, so that's why future is a organized forward. Future is also a forward, but it is organized. There is a third party system. The date of delivery of funds on the date on which the exchange of currencies actually takes place is known as the value date. So the exchange of currencies actually takes place is known as value date, or there is another name to this, that is known as settlement date. Both the things are one and the same. Value date or settlement date. Okay. So suppose if we decide on with each other that I'll pay you dollars, you will pay me rupees, and we will be doing this transaction after 2 days. So that will be spot. Forward rates are derived from the spot rates and are the function of the spot rates plus and forward premium or discount of the currency being quoted. Now what do I mean by this? Forward rates are always here. Always remember one simple logic. Forward rate equals to spot plus premium or minus discount. Now what do I mean by this? Suppose if you buy whenever you buy the shares in the stock market, you also know, you want to learn more about stock market. Teach market anywhere else. Okay. Yeah, I do teach stock market, because my main point is in stock market only. I'll tell you one thing about you guys, that premium and discount. Okay, there I'll explain you the stock market also. In the later classes, whenever we come to the options topic, there is an options topic to you. Okay, in that options topic, I'll teach you how the options market works and how the stock market works. Okay, I'll teach you there. So now just I'll give you the hint. Say this. Forward market is spot plus or minus premium, plus premium minus discount. Means what? Now look at this. Those who invest in shares, they'll know one thing. Whenever you hear that CNBC channel or any channel, they always talk of these options. Call and put. Options. Call and put. Call and put. Okay. So what do you mean by this in call and put? I won't go into the details now. Just I'm giving you what do you mean by premium and discount. If Reliance share right now is 2600, and in future, let's say after 7 days, this share is expected to go to 2700. So now what is happening? In future, the rate is going to be 2700. Now this is known as spot. This is a spot rate and this is the forward rate. So the difference between these two is known as the premium. Premium. So that's why what have we done? Suppose if I have to come to the forward rate and then the premium is what, 100. So if I have to come to the forward rate, so what will I do? 2600 spot plus premium 100. So I'll get this forward rate. Reverse is also the case. If the Reliance share is expected to fall down, then I'll do the discount or subtract it. Okay. So that is the logic behind this. Whenever we'll come to the stock market, actually the class of this options market and future market, you are having a separate topic in module B and in module A also somewhere. A also you are having it. So there I'll teach you how the call market works, how the stock market works, what are the, in fact you are having this in your ABM. In ABM, you are having a normal distribution curve. In normal distribution curve with 2 standard errors, stock market also works in that way only. Normal distribution with 2 standard errors. Okay. Now let's do one numerical. Suppose let's say this logic I'll give you. Let's say this spot is 80.23 or 33. Now what do you mean by 23 and 33? Whenever you have this rate like this, 23 or 33, always look at this, 23 or 33. It means that this left side is always the buy rate, bid rate. Left side is always the buy rate, bid rate. Right side is always the offer rate, sell rate. So for your CIB terms, you always remember buy and sell. Left is buy, right is sell. This is bid and offer. Okay. Now this is also called as ask, bid and ask. Okay. So now in forward market after 1 month, let's say this is given as this forward premium is given as like this 10.20. So what does it mean? Does this mean the currency is in premium or discount? It is in premium. Why? Because look at this, the right side is bigger. Whenever you have a right side bigger, the currency is always in premium. Whenever you have left side bigger, suppose let's say 1 month, this forward rates are 10 and 20, 2 month forward rates are 30 and 20. So your left side is bigger. So that's why the currency is in discount. Okay. So remember this logic. When your right side is bigger, the currency is in premium. When your left side is bigger, the currency is in discount. Now if I ask you, what will be the rate of that currency? What will be the rate of dollar for buying after 1 month? After 1 month buying. So when it is in premium, I'll have to add it, right? Spot plus premium. So what will I do? 8.23 plus 10. Look at this, plus 10. So my rate will be 8.33, 80.33. Okay? 80.33 over here. Okay? Next one. Suppose if I want to get the sell rate, 80.33 is the sell rate over here. Now I want the sell rate after 1 month. So it is 20 plus. So 80.33 plus 20. So it is 80.53. 80.53. So in premium, we always go on adding it. Whereas in discount, suppose if I ask you the rate after 2 months, so it will be 80.23 minus 30. Why? Because discount is subtraction. Big case studies which are directly asked in the exam. I'll be taking those case studies. Okay, some, not all immediately tomorrow. We'll go on and on. But remember, module A of yours is very important. Module A and B. If you focus on module A and B properly, okay, you will definitely gain almost 60 marks from module A and B only. A and B only 60 marks. Because these both the modules are numerical based. Module C and D are less of the numerical based. Okay. So now, coming back. Forward rate are the function of spot and forward premium or discount. Now, what do you mean by this? Now, this already I have discussed. So, it is the same thing. Spot and forward premium. So, a spot plus forward is a premium. If it's a premium, then spot plus premium. If it's a discount, then spot minus discount. Now, one important term which I have to come over here is this numerical or this logic over here. I'll tell you what it is. If the value of the currency is more than that being quoted in the spot, then it will be said to be in the premium. So obviously, if the future market of my flat is higher, then definitely what will happen? It's in the premium. If the future market value of my flat, whichever property which I am buying, or dollar or gold, whatever I am buying, if the future rate of that property or that commodity is lesser, then it is called as a discount. Now something difficult comes to you. Now this is difficult. If the spot GBP against USD is being quoted at 1.6 and 1 month forward is quoted at 1.6050, then GBP is dearer. GBP is dearer. Now what do you mean by this word dearer? Again, this is a new term to you, dearer. The value of 1 month forward, a premium of 50 pips. Pips means this, 6050. Okay, is being charged for the same. Now, what do you mean by this word dearer? Dearer means premium. Whenever any currency is in premium, it means it is called as dearer. Okay, whenever any currency is in premium, it is called as dearer. Okay. So if any currency is in discount, then it is called as nothing. There's no name to that. Then it's called as discount only. Okay. Now one important point which is there. Suppose the spot of GBP is given at 1.6000 against USD and a 3-month forward is given at 1.5000. Then the GBP is said to be at discount. The USD or the other currency is said to be at premium. Now what do you mean by this? Understand some differences in this, okay? The important differences which are there. Now look at this. GBP to USD. Look at this. You directly mark it over here. GBP to USD. Now this is which rate? GBP is given at what rate? Is it a direct rate or indirect rate? Okay. What is direct rate in foreign currency? Direct and indirect. Direct and indirect. What is direct rate and indirect rate? Suppose if I call of rupee, how do we call the rupee? Rupee rate. So rupee rate is always given as $1 equals to, let's say, 80 rupees. Okay. $1 equals to 80 rupees. So what do you mean by this? I can write it like this. Direct rate is always written like this. Dollar upon rupee. This is known as a direct rate. Dollar is in the numerator, rupee is in the denominator. Indirect rate means reverse. It is GBP, or I'll just write it G upon dollar. Here dollar is in the denominator. GBP is in the numerator, dollar is in the denominator. So this is indirect rate. In indirect rate, they write it like this. 1 GBP equals to, let's say, $1.5. So who is fluctuating over here? In direct rate, left side is always constant. In direct rate, rupee is fluctuating. And in indirect rate, dollar is fluctuating. Okay? Yeah. So importantly remember, whenever I give the rate of GBP, there are 4 currencies which are in indirect rate. GBP, AUD, New Zealand dollars, and there is one more currency, I think so, Euro. Yeah. So there are 4 currencies which are in this indirect rate. So GBP to USD right now is given at 1.6. Look at the question. GBP to USD is quoted at 1.6 against USD at spot. Whereas in 3-month forward, it is quoted at 1.5. So what do you mean by this? It means, look at this. Right now the rate is 1.6 to 1. So this GBP means to buy 1 GBP, I'll have to spend $1.6. And in future it is $1.5. So I'll have to spend less. So GBP is getting a discount, means GBP's value is decreasing. Whereas dollar value is increasing. Whereas in rupee, it is a reverse case. Rupee being 47.7069. The 6-month premium being 68.58 paise. This means USD is being quoted dearer in forward where the rate is this. Now, how do you calculate this rate? This is same as the earlier one. For example, this spot rate is given as what? 48.70. Now, who can give me the buy rate? 68.58 is the forward rate given, forward points given. Now, if I ask you the forward rate for the rupee, what will you quote me? 48.70 plus 68 or minus 68? Now, you guys tell me. Will you quote me plus 68 or minus 68? You'll quote me minus 68. Why? Because the currency is in discount. Look at this. Left side is bigger, right side is smaller. What did I say? Whenever left side is bigger, right side is smaller, it means the currency is in discount. Whenever I get a discount currency, I'll have to subtract it from buy also and sell also. Look at this. This is the answer I've got. 48.70 minus 68. So it will be 48.02. Similarly, 48.69 minus 58. So it will be 11. So my rate after 6 months will be 48.0. So USD is at discount while INR is at premium. Why? Why USD is at discount? Because right now if I want to buy $1, I'll have to pay 48.70. After 6 months, if I have to buy the dollar, I'll have to pay 48.02. So I'll have to pay less money. It means the value of that commodity is decreased. Let's say I'll have to buy 1 kg of potato today at 48.70, 1 kg of potato. And after 6 months, the same 1 kg of potato is costing me 48 rupees. So what will I say? The potato value has decreased. So USD is potato. USD value has decreased. Okay. So this is a discount. Any currency's value decreases in future, it is known as at discount. Okay. Whereas the INR is at premium. Now what do you mean by this? INR is at premium. Remember, whenever any currency is in discount, the other currency to this will always be in premium. Means if dollar is in discount, then rupee will always be in premium. Okay. If dollar is in premium, rupee will always be in discount. Okay. So that is the meaning of this. Got it? Everyone clear? So this concept is very important for you. Discount and premium. See how many of you can answer this. Let me bring in the slide. Hold on. Let's say present rate of dollar is 83.4050 and 2 months forward, the rate is, let's say, 20. Now tell me you all, this currency in spot. Now you tell me, in spot, the currency is in premium or discount? In spot, the currency is in premium or discount? In spot, the currency is in premium or discount? Okay. In spot, everyone is saying the currency is in premium. I will say it is wrong. It is not in premium. In spot, the currency is not in premium. Very good. Who's this? Tejas. Currency is neither in premium nor in discount. Always remember this by heart. Throughout your life, you remember this. Throughout your life. Premium or discount is not decided by spot. It is always decided by forward. Okay. Premium or discount will never ever be decided by the spot. It will always be decided by the forward. Okay. Got it? Remember this by heart throughout your life. Now you tell me, what will be the rate for 2 month forward? What will be the rate for 2 month forward rate? Give me the rate for 2 month forward. 83 point. What is the rate for 2 month forward? Somebody had given me this rate. Yeah. What was that? 6080. Keshav. Correct, Keshav. Others also. Correct. All of you are correct. So, oblique. What is that second one? 80. Okay. 83.60 oblique 80 for 2 months. Okay. What is the rate for 3 months? 3 months. 40.30. Now give me the rate for 3 months. 3 months. 3 months it is. Very good. 83.00. 83.00 and 50 minus 30. So for this, I'll subtract it. Why? Because the currency is in discount. This currency is in discount over here. And here the currency is in premium. Got it, everyone? So this is the basic you must always understand. Premium or discount will never be decided by the spot. It will always be decided by the forward. If the right side is bigger than the currency is in premium, then we'll have to add it. If the left side is bigger, the currency is in discount, then we'll have to subtract it. Okay. Discount are generally based on the interest rates. How do I decide this forward, premium or discount? Where will I decide? From where do I get these points? 20, 30, 40, 30. Where do I get it? It is always on the basis of the interest rates. What does the interest rate means? See here, this formula you had it in your CAIIB. CAIIB means what? That spot rate. How do I decide this forward points? The forward points formula was you had it in your CAIIB. Forward points. Remember this, anyone? Equals to spot rate, spot PNR upon 100. P into N. Suppose if I want it for 90 days. 3 months, 90 days. So 90 upon 360. You did this numerical also in your CAIIB. Into that interest rate, 4.5%. Let's say it is 4.5%. So 4.5 upon 100. So the answer which you get will be your forward points. Okay. So this interest rate is always decided on the differentials between the two currencies involved. Differentials means what? What do you mean by the differentials? Suppose in India, the repo rate is, right now the repo rate in India is what? 6.5. Right? Right now the repo rate in USA, this is in India. Okay? What is the repo rate in USA? USA it is roughly around, I'll tell you, 4.5 or 4%. Let's say 4%. 4.00. So what do you mean by differentials? Differentials mean the difference between these two. So 6.5 minus 4, so 2.5. So by 2.5%, dollar is stronger than rupee, stronger. So this is differential. Differential of the two currencies involved demand and supply of the forward markets. The demand and supply depends on the following factors. So on what factors does this demand and supply depend? Movement of capital in normal times as well as out of fear or fright or fear. Means movement of capital in normal times. Now in normal times, capital will always move from low interest to high interest. Simple logic, everyone will try to invest in higher interest rates, higher interest. Okay. So this is a normal logic of your normal capital, but fright and fear means if there is a war-like situation, then what happens? Everyone tries to buy the dollar. In any war-like situation, the dollar rate immediately goes up. Why? Because everyone tries to buy the dollar. Why? Because dollar is considered as a global currency. Okay. Second factor is status of exports and imports, trade balance, as also the balance of payment. Already I have discussed this. Financial and fiscal status of the countries, freedom to invest, move in and move out. So what do you mean by this? Look at this. Financial and fiscal status of the countries, freedom to invest, move in and move out, infrastructure, labor, political stability, activity, right? So demand and supply will depend upon that. So suppose, for example, if I tell you to invest, suppose if I tell you to, you want, who, Pooja, you wanted this repo rate difference? Why in the earlier USD was at discount? Didn't understand. Okay. See this. One important point. Suppose if I tell you to invest in, let's say, Sri Lanka tomorrow, will you invest? No. Why? Because financial status of the country, freedom to invest. You know, once money is gone, they're gone. It won't come back. Right? Now let me repeat these two factors which I have just now told you. Repo rate in India is 6.5, whereas the repo rate in US is roughly around 4%. So what is the difference? What does the sentence say? Sentence is that the forward premium and discount are based on the interest rate differentials of the two currencies. Interest rate differentials of the two currencies mean the difference between the interest rates. So the difference between the interest rate is what? 6.5 and 4. So 2.5. So dollar will be stronger than the rupee. Remember always, the country whose interest rate is lower, the country whose interest rate is lower will always have a stronger currency. Generally, again I'm saying generally, because there is an exception of Japan for this. Japan is having the lower interest rate, but then also its currency is weaker. But generally, the country whose interest rate is lesser will always have the stronger currency. And the earlier slide also you wanted something. What was this? This you wanted, right? Who wanted this? Earlier slide? Mamta, right? You wanted this in the earlier slide. So, USD, where were we? This, right? So, what has happened? What was the question of yours? Why USD was at discount? Which USD? This or the other one? Let me see. This one, this one. Yeah, here, there are two problems to this, okay? Remember, we'll separate these two problems over here. I know you might have got confused over here. These two are separate problems. These two are separate problems. This is related to GBP. Here, USD is in premium. See this, other currency USD is in premium in the first problem. USD is in premium. Whereas in our case, rupee to dollar, the USD is in discount. Why? Because the rate of USD is going down. Look at this. In the spot, the rate of USD was 48.7. Whereas in the forward market, the rate of USD was 48.2. I'll mark this yellow. Okay. In forward market, the rate of USD was 48.2. And in spot market, the rate of USD was 7. So that's why USD has become cheaper. So that's why it is in discount rate. In discount. Okay. Now understand this thing. I'll give you a simple example. Very simple example. Suppose if you are having potatoes. Okay. You go and buy the potatoes in the. Let's say the potatoes are right now at 60 rupees per kg. And if somebody tells you that don't buy potatoes right now, after 3 days or after 7 days, the potatoes, the rate of 60 is going to come down to, let's say, 30 rupees. The rate of potatoes is going to come down to 30 rupees from 60. So what will you say? Potatoes will become cheaper in 1 week. So that's what is meant over here. USD is same as that potato. Right now the potato or dollar is at 48.7, but after 6 months the dollar will be at 48.02. So dollar will become cheaper. Dollar will become discount. So if dollar is in discount, it means somebody goes stronger. So who grows stronger? Rupee goes stronger. It's like this. It's like that. Opposition becomes weaker, the other party becomes stronger. If the other party becomes weaker, opposition becomes stronger. That's a simple rule. Okay? It's always a two-party system and two-way system. Okay? Chalo, bye everyone for today. And those who are watching on YouTube, kindly join the classes right now, okay? Because further, today was a basic. Further, after this, I don't think so. Free classes are available on YouTube from tomorrow, okay? So those who are watching on YouTube, kindly join the classes immediately, okay? Also, those who are in the classes, don't forget to give the ratings at the end. Whenever you close the class, you'll get a ratings field, okay? Give the ratings immediately, okay, everyone? Yeah. Stock market, I'll tell you whenever we come to that topic, okay? Because stock market is out of the purview over here, but I'll tell you definitely. Classes, I don't take that much classes here. I do take personally, but that's a separate, altogether a separate thing, okay? I'll teach you, na, don't worry. You are in this class, I'll teach you how to handle these basics, investment part, because that is a part of your studies also. Remember, the stock market studies are the part of your BFM studies. Options market is there in your studies, options and forwards. So there I'll have to teach everything.